Cigar Lake is back. The world's highest-grade uranium mine restarted production today after a 2-week acid plant shutdown. And Cameco says not 1 pound of 2026 guidance was lost. That is the headline. The rest of this week is more complicated.
Yeah, much more complicated.
Right. So welcome to the Deep Dive. It is Wednesday, July 15th, 2026. And we've got a lot to cover today, 3 days into the week. And here is where uranium currently stands. Start with a number.
Please start with the number.
Uranium spot sits at approximately $85.70 per pound this Wednesday. Week to date, it's essentially flat. I mean, it's down a nickel from last Friday's $85.75. So what is the market actually doing here?
Well, I mean, the spot market is doing exactly what it has done every single week since April, which is absolutely nothing.
Right. Just totally flat.
Exactly. We are looking at 7 consecutive weeks stuck in this really rigid $1 trading band, And this week is honestly shaping up to be exactly the same.
But that flatness on the surface, it's kind of masking some really intense volatility underneath, isn't it?
Oh, absolutely. I mean, over the last 3 days alone, we saw Cameco drop 6% on Monday.
Wow.
Yeah. And then Uranium popped 5.1% on Tuesday. We've got the Cigar Lake restart officially confirmed today. The U.S.-Iran ceasefire is gone. So there's a massive amount of structural movement happening right now. Just, it isn't showing up in the spot price yet.
Yeah, and before we jump into all of that, let me just give you, the listener, a quick overview of what we are working with today, because we have a pretty thick stack of fresh sources in front of us.
I really do.
Yeah, we are looking at official SEC filings from Cameco, a brand new analyst initiation note from RBC Capital Markets, and the latest long-term pricing data from Trade Tech and UXC.
Because if you're tuning into this, you don't just want the highlight reel, right? You want the actual mechanics.
Exactly. You want to know what's happening behind the curtain. So here's our mission for you on this deep dive. We are going to explore exactly how the two foundational pillars of this current uranium bull market, so that's structural supply tightness and institutional demand growth, how those were massively stress tested over just the last 3 days.
And it really was a stress test.
Yeah, big time. And perhaps more importantly, we are going to figure out what the $9.30 premium between the spot and term prices tells us about, well, where the smart money is actually going right now.
I really like that framing, to be honest, because the headlines, they only ever give you the what. We need to dissect the why, and the how. When you look at the raw data from Monday to Wednesday, it looks incredibly chaotic.
Oh, totally chaotic.
But there is actually a very clear, logical through line connecting all these events if you understand the underlying mechanics of the nuclear fuel cycle.
Okay, so let's unpack this. Let's go right to that first pillar, which is supply. We know Cigar Lake is back online, but let's look at the anatomy of that panic we saw on Monday. Here is what actually happened on the ground, right? On July 1st, Cameco had to suspend mining.
Right, but the mine itself didn't actually break.
Exactly. It was Orano's adjacent McLean Lake processing mill.
Yeah.
They had a failed expansion joint in their sulfuric acid production unit. Now, why does a mill breaking down stop the actual mine? Because, well, Cigar Lake has highly limited storage capacity on site. They literally had nowhere to safely put the rock.
And I think we should clarify why that is, for anyone newer to this.
Yeah, go for it.
This isn't like a coal mine where you can just pile the rocks in a field indefinitely. Cigar Lake produces the highest grade uranium in the world. So it requires highly specialized radiation shielding, strict water management, and massive regulatory oversight.
Right. It's heavily monitored.
Exactly. So when the mill that processes that ore goes down, the mine simply has to halt. It's literally a logistical bottleneck by design.
Okay, so the teams work around the clock. They managed to fix the acid plant by July 11th. And the official 6K, which is, the formal regulatory filing that foreign issuers submit to the SEC, that drops today, Wednesday, along with the press release.
Right.
Now, Cameco owns 57.418% of Cigar Lake, which translates to roughly, 10.3 million pounds annually for their share?
Yeah, that's about right.
So here's my question for you. Think of this like a structural stress test on a bridge. If the actual mathematical impact of a 2-week shutdown is, relatively modest for a mine of this massive scale,
Sure.
then why did a temporary pause wipe out 6% of a major company's value so quickly when the market opened on Monday? I mean, the stock dropped all the way down to $90.20.
Well, what's fascinating here is the psychology of a bull cycle, right?
Sure.
In a structural bull market, Investors are constantly looking over their shoulders for the one thing that breaks the thesis. So a sustained disruption at Cigar Lake.
The biggest mine in the world.
Exactly. A sustained disruption there would have been the very first disclosed production miss in the current cycle at a Tier 1 Western asset. That is symbolically massive.
Right. So people just panicked.
Yeah. The swift sell-off you saw on Monday, it really shows how hypersensitive this market is to supply chain uncertainty. It isn't just about the loss of a few weeks of production,
It's the fragility of it all.
Precisely. It's the sudden realization that the global supply chain is resting on a knife's edge. A single failed expansion joint threatened the most important uranium mine on the planet.
Wow. So the market was basically pricing in the worst-case scenario over the weekend before they even had all the facts.
That's the prevailing reality of how this market trades right now, yeah. But then, Wednesday's news flips that narrative completely on its head.
Because they fixed it.
Because they fixed it. Cameco and Urano repaired the acid plant internally, and honestly, relatively quickly. So Cameco gets to walk into their Q2 earnings call on July 30th with a completely pristine narrative.
Right. And remember, they are coming off a massive 38% earnings per share beat in Q1.
Exactly. So now they can look institutional investors in the eye and say, look, our supply chain was severely tested, our teams managed the repair in-house without any external bailouts, and our 2026 guidance of 17.5 to 18 million pounds remains absolutely unchanged.
That is a massive flex.
It really is.
Okay, so that's a totally resolved risk on the supply side up in Canada, which naturally drives us to what's happening on the demand side, because that extreme hypersensitivity we just talked about perfectly explains why the market is so on edge about what happened next in the Middle East.
Yeah, this is the other half of the story.
Over the weekend of July 8th through the 10th, the Versailles Memorandum ceasefire between the U.S. and Iran completely collapsed.
It all fell apart.
Right. We saw fresh strikes, a total deadlock over the Strait of Hormuz, and President Trump taking to social media to declare the ceasefire, quote, over. Now, just to lay out the facts, Pakistan and Qatar are trying to mediate right now. And technical nuclear talks are reportedly continuing quietly on a separate channel, but that main diplomatic framework is essentially void. Now, I want to emphasize, we're keeping a strict separation between political theater and market mechanics here, right? We are not endorsing any political viewpoint or taking sides. We're just looking at the source material and how this shifts capital.
Absolutely. We just look at the data. And this situation demonstrates exactly why the uranium market is currently running two simultaneous, very tense narratives.
But here's where it gets really interesting, and I have to push back a little on the prevailing sentiment here.
Okay, let's hear it.
Are we just looking for reasons to be bullish? I mean, how does a collapsing Middle East ceasefire actually help the uranium market if spot prices are sitting perfectly flat at $85.70? The spot price literally didn't blink when the ceasefire collapsed.
It's a great question. And it comes down to a binary dynamic and how risk is priced by the market.
What do you mean?
Well, before this weekend, the prevailing fear in the uranium space was that a successful U.S.-Iran nuclear deal would significantly lower the global geopolitical risk premium.
Ah, okay, so peace means lower prices.
Right. If the Middle East gets peaceful and predictable, the fear was that the uranium spot price could retreat down to the, say, $82 or $84 range. Yeah. But with the collapse of the ceasefire,
that downside risk is gone.
Exactly. That specific downside risk is completely wiped off the table. The floor is protected.
Okay, so the downside is removed, but what's the upside mechanism then? Why would prices go up?
The upside mechanism is the new reality of energy security. If this conflict disrupts global shipping through the Strait of Hormuz, which, by the way, handles a massive percentage of the world's oil and liquefied natural gas.
Right, it's a huge choke point.
Yeah. If that happens, or if it escalates into a broader energy crisis, you are going to see governments panic. And we need to explain why nuclear is the specific answer to that panic.
Because it's so dense.
Right. Yes. Uranium is incredibly energy dense. A single uranium pellet, like the size of a gummy bear, contains the exact same amount of energy as a full ton of coal.
That's crazy to think about.
It is. And because of that density, a sovereign nation can stockpile 5 years' worth of baseload power in a single secure warehouse. You just cannot do that with natural gas or oil.
So when governments panic about energy security, they look at nuclear because it's basically the ultimate hedge against supply chain warfare.
Precisely. They accelerate their nuclear procurement timelines. And we actually saw proof of this earlier this week when Italy formally restated its interest in restoring domestic nuclear capacity.
Oh, wow.
Yeah, that is a direct reaction by a European government to the volatility of global energy markets. They are looking at the Middle East and saying, we need our own baseload power, and we need to secure the fuel for it today.
Which brings us to a really natural thematic pivot. If global supply chains in Canada are proving to be, sensitive to a single expansion joint, and international waters in the Middle East are turning volatile, the obvious reaction is a massive pivot to domestic security.
Exactly.
Which brings us to Tuesday. RBC capital markets analyst Andrew Wong initiates coverage of Energy, that's ticker URG, with an outperform rating and a $1.75 price target.
Which is a big deal.
A very big deal. The stock jumps 5.1%. Uranium Energy Corp, or UEC, adds 2.1% on the same day. And they're getting a boost from some Washington nuclear bill momentum and some Paraguay critical minerals exposure that the Motley Fool noted.
Yeah, the whole sector moved.
But hold on, before we get into the broader domestic complex, I want to pause and just define what Energy actually does, because I think it's central to why they're getting this attention.
Okay.
So they operate the Lost Creek facility in Wyoming, and they just completed their 100th shipment. But they don't dig massive open pit mines, right? They use a process called in situ recovery, or ISR.
Which is a crucial technological distinction to make.
Can you break that down for the listeners?
Sure. For those unfamiliar, in situ recovery doesn't involve moving millions of tons of earth. Instead, they just drill wells into the ore body, pump down a solution. Usually, it's just oxygen and baking soda, which dissolves the uranium directly within the sandstone.
And then they just pump it up.
Yeah, they simply pump that uranium-rich water back up to the surface. It leaves almost no environmental footprint on the surface compared to conventional mining.
That's amazing.
And Energy uses this hub-and-spoke model, meaning they have one centralized processing plant, the hub, that can process the uranium-rich water piped in from multiple different well fields or spokes, miles away. It is highly capital efficient.
I look at this like the farm-to-table movement, but for nuclear energy.
That's a good way to put it.
Yeah, it's not just about getting the uranium anymore. It's about knowing exactly whose backyard it came from. Utilities want it sourced locally, cleanly, and safely. But so what does this RBC rating mean for the broader market? Is this just a standard commodity play, or is this something else entirely?
It is definitively not just a commodity play. This is what we call a political economy call.
A political economy call?
Yeah. When RBC's Wong initiated coverage, he didn't just point to the price of uranium. He explicitly cited U.S. government policy support. Specifically, he pointed to the $900 million commercial contract signed by Centrus on July 1st for HALEU.
Okay, let's define HA really quickly. That stands for high-assay, low-enriched uranium, right? It's the specialized fuel enriched between 5 and 20% that is absolutely required for the next generation of advanced small modular reactors.
That's exactly right. And historically, Russia was the primary commercial supplier of HALEU for the entire world.
Right, which is obviously a problem now.
A huge problem.
Yeah.
So by the U.S. government injecting $900 million into a domestic company like Centrus to build that capacity at home, major banks like RBC are now actively underwriting the durability of U.S. government policy.
Wow.
They're looking at Washington's actions and saying, we believe this funding and this political wall around the U.S. supply chain will last.
And that basically gives institutional money the green light to jump in, doesn't it?
It's massive for sideline institutional capital, specifically because of ESG constraints.
Environmental, social, and governance rules.
Exactly. There are massive funds out there that desperately want exposure to this uranium bull market, but their internal ESG mandates strictly prohibit them from touching Russian or Kazakh supply chains. They literally cannot buy those equities.
So they've just been sitting on the sidelines watching the price go up.
Basically, yeah. So when a major bank validates the U.S. domestic supply chain, it gives all that sideline capital a viable, compliant way to finally invest. It lifts the entire domestic complex. It's not just Energy. It benefits Uranium Energy Corp, Encore Energy, Peninsula Energy, all of them.
Wow. Okay, so let's just take a breath and look at the board here.
It's a lot to take in.
It really is. We have Cameco surviving a massive operational stress test. We have the geopolitical chessboard fracturing and removing the downside risk for the spot price. And we have Wall Street heavily backing the U.S. domestic production story. But that brings up the absolute elephant in the room. If domestic policy is booming, the Middle East is on edge, and Cameco just survived a near miss, Why is the spot market doing absolutely nothing?
Yes.
I mean, 7 straight weeks in a $1 trading band, flat at $85.70. What is the disconnect here between these wild equity swings we saw in CCJ and URG and this totally flat spot price?
The disconnect exists because tracking the spot price alone is a complete trap.
Really? A trap?
Yes. The spot market in uranium is tiny and relatively illiquid. To really understand where this market is going, we have to look ahead to the pending catalysts. And specifically, we have to look at the term market.
Let's do that because
Yeah.
we actually have some major data prints coming on Friday.
We do. On Friday, we get the TradeTech and UXC spot price indicators. But the number you really need to care about is the UXC long-term term price. Currently, that sits at approximately $95 per pound.
$95, which is $9.30 higher than the current spot price. That is a massive spread. It's like paying well over sticker price for a car today just because you know the factory is shutting down tomorrow.
That's a perfect analogy.
Uh-huh.
You aren't paying for the car. You're paying for the certainty of having a car.
Yeah.
That $9.30 spread is the defining structural feature of the uranium market this year.
It's the whole story.
It really is. Think about what that actually means in practice. The utility companies that run these nuclear reactors, the entities conducting the most consequential, massive, multi-year uranium transactions, they are gladly paying $9 above the current spot price just to secure their future supply.
Wow.
They are locking in contracts at $95 when they could technically buy spot at $85.
Because they know that spot supply simply won't be there in the volumes they need 3 years from now.
That is the core of it.
Yeah.
It is absolute mathematical proof that the forward supply is structurally short. They aren't waiting for spot to drift down. They are paying a premium today to guarantee their reactors don't go dark tomorrow.
Okay, so term pricing is flashing a massive structural shortage. What else are we waiting for as we head into Thursday and Friday? Because the picture you just painted means the market is essentially holding its breath for new supply to materialize.
We are waiting for two massive shoes to drop on the supply side.
Okay, what's the first one?
First, we are waiting for Kazatomprom's Q2 operations update, which is expected before August 3rd. Remember, Kazatomprom is the largest uranium producer in the world.
Right.
In Q1, they actually showed a 9% year-over-year production increase, hitting over 6,000 tons of uranium. And that's despite their management constantly preaching a strategy of value over volume.
Right. They said they were going to hold back, but then they pumped more.
Exactly. Their full-year guidance for 2026 is 27,500 to 29,000 tons. The market desperately needs to see if Q2 production is actually tracking that guidance or if it's falling short.
And the second shoe. Because I know this is the one that has the development side of the market sweating right now.
The second shoe is NextGen's Rook I project up in Canada.
Ah, yes. The silence.
The silence is deafening at this point.
Yeah.
We are now 3 weeks past their June 30th annual general meeting. NextGen has stated they are targeting a summer 2026 window for construction start. But we have had complete radio silence on-site mobilization.
Nothing at all.
Zero news on shaft sinking preparation. Nothing on civil earthworks commencement.
We really have to explain to listener why that summer window is so incredibly critical, because summer in northern Saskatchewan is not exactly a long, leisurely season.
Oh, it is incredibly narrow. The region is covered in muskeg, which is basically deep, swampy peat bog. You literally cannot move heavy construction machinery across unfrozen muskeg without sinking.
It just swallows the trucks.
Pretty much. The functional construction window for massive earthworks runs essentially from June through September. So every week of silence narrows their margin of error. Summer 2026 is rapidly turning into late Q3. Now, to be fair, they do have their Canadian Nuclear Safety Commission license, and they have their final investment decision on record. Long-term thesis isn't broken. But this is a 30 million pound per year behemoth of a project.
It's huge.
It is the single highest conviction potential catalyst in the entire Western uranium development pipeline.
So let's tie this all together for everyone listening today. Because if you came into this week just checking the ticker symbol for the uranium spot price, you would think absolutely nothing happened.
You think it was asleep?
Right. $85.75 on Friday, $85.70 on Wednesday, a drop of a nickel. It looks like the most boring market on Earth.
But underneath that surface, it was arguably one of the most intense stress tests of the entire bull cycle.
Exactly. You had Cameco put through the ringer, proving that they could survive a totally unpredictable supply chain failure at a Tier 1 asset without losing a single pound of their annual
All
guidance.
right.
You had the geopolitical chessboard completely fracture with the U.S.-Iran ceasefire collapsing, reminding European nations exactly why they need to secure their own independent nuclear baseload power.
Absolutely.
And then you had Wall Street firmly putting its weight behind the U.S. domestic production story, validating that the policy checks being written in Washington are actually creating a safe haven for ESG-constrained institutional capital.
It is a phenomenal setup, and it proves exactly why obsessing over the spot price is the wrong strategy right now.
Yeah.
The real story of this market is being written in the term market premiums, where buyers are happily paying a $9 premium for security. And it's being written in the equity volatility beneath the surface, where we saw massive daily swings based on supply fears and policy validation.
Which leaves us with one final thought to mull over. We've seen how jumpy this market is right now. We watched the market violently drop Cameco stock 6% in a single morning, all over a temporary 2-week acid plant shutdown at a producing, fully operational Tier 1 mine.
Yeah, just 2 weeks.
So, based on everything we've unpacked today, I want you to take this scenario with you. Imagine the absolute shockwave that will hit this market if a real structural delay actually hits a 30 million pound behemoth like NextGen's recurred, just as that narrow northern Saskatchewan summer construction window rapidly closes.
That would be wild.
Thank you for joining us on this deep dive. Keep your eyes on the term premiums, and we will see you next time.